Are we now entering a short seller's market?
I think over the longer term here, I'm very concerned about AI and what AI does to jobs and the economy. So I think over several years, and the timeline is a little bit squishy on this, but I think over several years we're going to have a significant financial event, dislocation, where if you've set yourself up right going into it, I think it could be somewhat similar to the GFC in terms of how short sellers made significant returns during that period.
So by GFC, you mean the big financial crisis that happened in 2007, 2008?
Exactly. I mean, it's little consolation because when we come out on the backside of that, I think it'll be a greatly reordered society after a lot of turbulence. So to me, the one thing that really matters that is not getting enough discussion in terms of the long-term picture is AI. The short term here, the Fed's probably going to ease, but do we have inflation coming back? How long will the war in Iran last? To me, those are unknowables. And when a lot of it depends on what you think this administration or this president is going to do, I think trying to be a Trumpologist is a sucker's bet. I mean, I just explain to people, look, he's a volatility machine. You have to understand that. So that's the one thing I feel good about with financial markets and this administration is expect the unexpected. Over the long term, I think AI is going to potentially really break the stock market because the combination of that and passive investing, how passive investing has set up all this fragility in the market. So I'm concerned about that.
Fragility because people aren't paying attention to individual stocks anymore.
Well, the thing is, you've had so passive has kind of become the market. And when you look at how companies within the major indices, so say the S&P 500, when you look at what is driving those movements, a lot of it is just passive flows, and companies can turbocharge that with share buybacks. But when you see the dispersion, such a small number of these companies are driving the mean of the index performance, that's great on the way up. But the thing is, if we get to a point where there are a lot of layoffs, because a lot of these flows have come from target date fund contributions, 401k fund contributions. So if you get layoffs of knowledge workers, well, they stop contributing to 401ks, there are not going to be, new knowledge jobs created for them. They will take redemptions. You'll get to a point where there's net selling by the target date funds, and combine that with people also selling from their taxable assets because they need to fund their lifestyles. And there's not a lot of active money anymore there to catch the falling knife. When this breaks, when you get those flows to reverse, we'll have a 1929 magnitude correction at 2020 speed. So that is, that will be an issue. Look, if you're short going into that, obviously you could do okay. Don't get me wrong. I'm not rooting for that because I don't want to live in this post-AI world or AI world that I think we're going to. But, I'm not driving the bus on this. I'm just a passenger. So I'm going to do my best to position the portfolio for, my client and myself.
Let me ask, another thing that has made the market for shorting really tough the last 5 years is the retail Robinhood trader, right? Meme stocks from GameStop 5 years ago to Open Door last year, they've squeezed a lot of investors. How have you had to adjust your process, just to account for that possibility?
Well, it's interesting because when GameStop happened, that was really the end of it. Although it didn't seem like it at the time. One of my colleagues, Andrew Left of Citron Research, he was the one publicly short GameStop, and this huge squeeze that was organized on Reddit caused him a lot of losses. And then he said, okay, I'm done with short selling. And turns out that, after that, these stocks were especially these really speculative companies, they had a horrible year in 2021 after GameStop. So, we were initially really cautious. So we didn't actually launch a new short activist campaign until March of 21. So GameStop happened in January of 21. And we shorted a company that was a SPAC called XL Fleet and claimed to do vehicle electrification. We were really cautious. And the moment we saw some call buying along with a few people tweeting like, oh, let's go squeeze the shorts, like we got out of that position quickly.
So you're monitoring Twitter really carefully.
At that point, yes. So as short sellers, we, my firm, we definitely try to avoid situations where it looks like there's a compressed or compressing spring. Now, maybe we don't always get it right, but that's, risk management is first and foremost how this business, how short selling works if you're going to stay in the game.
We're going to take a quick break, and when we come back, we'll have more with Carson Block of Muddy Waters. So there's been a lot of talk and WSJ reporting about whether we're in an AI bubble, and you referenced this before. Do you think we are? And if so, is there an effective way right now to short AI?
Well, yeah. I could pound the table and say that's the wrong question. We got to talk about what is AI going to do to society, the economy, the markets, et cetera. But look, the first thing is when we think about, I don't buy the comparisons to the internet stock bubble of the late 90s that popped in March of 01, in the sense that the companies that are investing in AI are these incredibly large, very well capitalized companies. And for the most part, they have, even with all the debt they're taking on, these are very manageable debt loads relative to their cash flows. So are they potentially overinvesting? Will we look back and say, well, these were value destructive investments? Yeah, it's possible. But these companies, Microsoft is not going out of business because of this. Google is not going out of business. Facebook is not going out of business. Look, the most marginal player in that space by a long shot is CoreWeave, but that's not a consequential company. So if you're asking me, can these stocks go down because of these investments? Yeah, they can go down because of these investments. But if you also back up and you go to that scenario where passive flows reverse and everything crashes pretty hard, the irony will be, under that view of what's going to unfold, that at least for some period of time, the hyperscalers, which are principally driving the index, the S&P 500 index, and to some extent Nasdaq, that they will be their own stock price undoing as the AI they're developing or helping to develop displaces workers. So there'll be some irony.
Because they're relying on those flows from target date funds, as you talk.
In that scenario, financial markets break. Now, here's the good news. We developed the technology to bail out the markets, right? So I think that from a financial market perspective, we end up putting the toothpaste back in the tube ultimately. But similar to 08, I think there's a lot of asset value loss that happens first. But at the end of the day, the people with assets, those assets will be reinflated by government policy because we're on that treadmill. There's no way to get off it.
But you're mostly thinking of that as tied to AI-related job losses.
I'm not saying this is likely, but within 3 years, and if it's not 3 years, it's 4 years, it's 5 years, I would say that's likely. 15% of knowledge workers lose their jobs. Why? Okay. First thing is keep in mind that AI right now, the progression in the capability of AI models is no longer linear. Okay, this version of Claude is a step up. Why? Because this version of Claude and ChatGPT were coded by their predecessors and tested by their predecessors. These versions are coding and testing their successors, and that will continue to happen. So we are at that inflection point where the capability goes exponential.